So, am I audible properly?
Yes, sir.
Okay, so we will wait for another 3 minutes and then we'll start. And Sudipto, is everyone join?
And they're still joining some of them. Yeah, but by maximum are there, sir.
Okay, so yeah, so just wait for another 3 minutes and then I'll start.
Sure.
Okay, so we start now. Today we start with the money market hedge. Okay, so why we call this strategy or technique as a money market hedge? Because we need to upfront invest a surplus money or whatever may be the excess cash available with us. Okay, just try to understand. If I need to pay, say for 100K US dollar after 3 months. Okay, I'm giving an example from India prescriptive. So today's rate is basically for 1 US dollar, say for 80, and it is expected after 3 month. Okay, this could be 1 US dollar is 82. Okay, so there is a because it is a payable, so I need to pay the 100K US dollar, I need to expense out more INR. Okay, so I can foresee that in future or after 3 months I need to bear some loss. Okay, today I have a surplus money. Okay, so what I'll do, I will not wait for 3 months. I will convert this 100K US dollar today's rate. Okay, today's rate, and then deposit for 3 months in US bank. Okay, and on maturity, I can fulfill my obligation okay, whatever may be the proceed I received from the FD. From FD. Okay, so that is basically what I'm doing here. I use the exchange rate of 80, not 82. I have not taken any risk of further strengthening the exchange rate, further strengthening the US dollar. Okay, so that risk I have avoided. I use the exchange rate of 80, and this way I can manage my payable. Okay, so we can work out in an Excel. So say for like payable amount is in the same example, payable amount is 100,000. Okay, interest rate in US dollar, USD 4 per. I can consider yeah 4%. Okay, so for one quarter it is 1%. Okay, so like how much I need to invest in FD. It is basically 100,000 divided by 0.99. Sorry, no, 101%. So it is 99,000 I need to invest, so that after end of quarter, I mean the interest amount which I supposed to receive for 3 months is 1%. So my total amount is 100,000, like this. This is my principal investment which I need to make in an FD. I am able to get the interest. Okay, this is principal, this is interest. Okay, and that is my total payable after 3 months. Clear? Okay. Now what happened? I mean, how much INR I need to spend today? This multiplied by 80, because I am investing this amount only. 99,000, how much? Yeah, 99,009.9. Okay. So for that, with an exchange rate of 80, I need to invest 79,20,792. Okay. If I, instead of going for this strategy, if I need to pay after 3 months, so how much amount I need to pay? This is basically 100,000 multiplied by 82. Without, okay. So here we are able to save the loss. I mean, instead of 82 lakh, I need to expense only 79 lakh 20,000. So this is my saving. Okay. Are you able to understand? What I did here, instead of like wait for 3 months and like go with an higher exchange rate, what I decided, I will convert the INR amount to the US dollar, which is my actual payable. Then I deposit in the US bank so that I can earn some interest for a timing, for the period for which I can maintain a credit. Okay, and whatever may be the net proceed after getting an interest, which is equivalent to my total payable, equal to my total payable. Okay, and if I adopt this strategy, then I need to pay 79 lakh 20,792 INR. If I have not adopt this strategy, then I need to pay after 3 months, of course, 82 lakh, and this may generate a saving of 27 lakh, 2,79,000, approx 208. Okay. So this is what happened when we have an excess cash. If say for I don't have an excess cash, then how I can do it? Okay. What I need to do then, this amount I need to borrow. Okay, and this may carry certain interest rate, say for 12%. Okay, so if it is 12%, so for the quarter it is a 4%. Okay, so it is 3,16,000. When I borrow a 79,20,792, I need to pay the interest on it for a 3 month, which is 3,16,831. Okay, so my total payable in this situation is this one, 82 lakh 37,000. But if I wait for 3 months, then it is an 82 lakh. Okay, so in this situation I need to pay the more amount, which is 37,000. Okay, so 37,623 I need to pay. So in that situation, maybe it is not a wise decision. Okay, but tomorrow if the exchange rate, expected exchange rate is 85, say for, but in that situation, if the exchange rate, expected exchange rate after 3 months is 85, then there is a saving of 2,62,376. So this way we can utilize the money market hedge strategy to offset or compensate any exchange loss which may need to incur. Okay, so it is all on expectation. That's why you need to do this kind of calculation, and then you can decide whether you need to go with a money market hedge or not. Clear? Are you able to understand? So we will take the example with illustration which is given here. So Duffy's discount Pintas has payable due to its Mexican suppliers in the amount of 1 million pesos in 90 days. Current exchange rate is 0.08 per peso, and Mexican interest rate are 16%. Okay, so Duffy has an 100,000 in US dollar exchange excess cash, and elect to use a money market to mitigate the transaction exposure to exchange rate risk. So Duffy performed the following step. Okay, so how much first amount need to invest to clear the payables? Okay, that we need to see, which is basically the payable amount is 1 million. Okay, so and we can get the interest at 16% per annum. Okay, so what does it mean? We can get 4% for 90 days. Okay, so that's why we need to pay, we need to invest 1 million divided by 104%. Okay, so 1 million should be along with the interest. So that's why 1 million divided by 1.04. So this amount is 961,538. Okay, then how much US dollar I need to spend to purchase 961,538? So which is basically multiplied by exchange rate 0.08. Okay, so 1 peso is equals to 0.08. Okay, so that's why the 961,538 multiplied by 0.08. So this US dollar I need it. Okay, so which comes to the 76,923. Okay, so it is more than 100, more than the 100, 100K US dollar which is available. Okay. If I am not adopt this strategy, then how much I need to pay? 100 multiplied by 0.08, which is equivalent to 80,000. So this is also 80,000 USD. So if you see here, there is a saving of um, 3077, and plus if any variation arises in exchange rate, okay, so that also the additional saving means instead of this 0.08, if it is 0.09, so in that situation that amount also we can save here. Okay, so this is my total saving because of change in interest rate. Okay, so that is basically the money market hedge. Keep in mind, we saw future and the forward option. I think we have not seen. Okay, so beside that, there is a money market hedge. If there is a word money market, that means you are utilizing your current money, okay, to manage any exchange rate fluctuation or the interest rate, differential interest rate. Okay. So again, the same example, if I do not have a surplus money, then what would be the situation? So it is 90 days, 16%. US interest rate as 6%, it is given. So you need to pay on 76923 um, additional interest, 76923 multiplied by 6% divided by 4 roughly. Okay, so this amount 76923 multiplied by 1.5%. This is an additional interest you need to pay, which is 1153.8845. Okay, so now the total payable is. So it is 1153 is the additional interest you need to pay. Okay. And 7692 923 is basically the conversion amount. As I don't have a surplus amount, so that's why I need to borrow the fund and which attract additional interest 1153.85. So in that situation, my total payable is 78076. Okay, it is again less than 80,000. Okay, less than 80,000. So again, in that situation, even if I borrow the fund, still money market hedge is preferable in this scenario. Means whatever the numbers we have. Okay. So this kind of calculation we need to do, and then we decide whether we need to convert a money today only, or we need to wait for credit period, let it be complete, and then we can pay whatever the interest which we are able to get in domestic territory, whatever the interest which we are able to get in the foreign territory. All that factors we need to consider, and then we need to calculate which is the best possible mechanism. Any doubt here? Okay. Now, I mean, whatever we saw, this is for payable, and in receivable, the same thing. The only thing is that either we need to deposit the money in their country or deposit the money in our country. Okay. So here, Duffy's discount Pintas as receivable from a Mexican customer in the amount of 1 million pesos due in 90 days. The current exchange rate is 0.08 per peso and the Mexican interest rate is 16%. Duffy needs available cash and cannot wait to receive 80,000 in 90 days. So because Duffy needs the money now, the company sorry, the company elect to use a money market hedge technique to expedite collection and mitigate any transaction exposure to exchange rate. Okay, okay. So in that situation, what happened? Foreign currency, we took a loan in a foreign currency, which is basically 961 538. Okay, and then it get converted to 76 923. Okay, the way we discussed first. Okay, and we are going to pay the interest on it. Okay, say for 4%, the amount of interest is, which is 38,461, and then 961 538 plus this interest, which is almost 100. So whenever I am receiving this amount, I will clear this loan. Okay, the same calculation what I did means if I receive 100,000 or sorry 1 million in a foreign currency, which I converted after paying the interest, whatever the amount I am able to get it, and then that amount I converted to the USD, which I can utilize for my domestic operation. Okay, and when I receive the amount from my customer, whatever the amount I receive, that I apply for payment of principal as well as interest. Okay, so this way I can do a receivable money market hedge. Any doubt here? This strategy we generally adopt in case of the receivable when there is a shortage of money with us. Okay, any confusion, any doubt here? Are you able to understand? Means it is a simple phenomena. You just need to evaluate, or you are going to take the benefit of differences in the interest rate. Okay. So, like whatever the amount you are able to deposit in a foreign currency, whatever the interest you are able to get in a foreign currency, okay, that you need to compare with the domestic obligation. Okay, so and accordingly you need to evaluate which is basically the most preferable solution for you. Then option. In option actually means it is similar to forward and future. Forward and future. Okay, but like in an option, may, so in an option, the only major benefit is like the option buyer is not under obligation. Means it is at his option whether to execute the contract or not. He can, he may, if he want to lapse the contract, if the regular exchange rate is beneficial for him, okay, so he may decide not to enter into the contract and let it be lapse the contract. So that is the benefit available in case of the option. In forward and future, it is compulsory on both the party to execute or fulfill their obligation. But in option contract, it is not necessary for the buyer. Okay, the underwriter, he is under obligation. Okay, means the other party who is buying or who is Yeah, who is mostly selling the option. Okay, so he is under obligation, but the buyer, a buyer of the option, maybe it is a call option or put option, he is not under obligation. Okay, call option is right to buy. It is a right, and the put option is right to sell. Okay, so this way you can do. Okay, so one more issue, because it is a right, not an obligation. So you need to pay a small premium amount. Okay, it is a fixed fees, and not refundable devil even if you not interested to execute the contract. Okay, so what happened here, that premium is basically just like an insurance premium. Okay, like if there is any loss happened, then someone is going to compensate. Okay, he is under obligation to compensate the loss. Okay, so because of that reason, whatever the premium you are paying to enter into the contract, that is not refundable. Okay, and so loss is always limited to the premium amount. Limited to premium amount. Okay, just consider one practical example. Say for you are a buyer of the option. If you are a buyer of the option, then what happened? You are not under obligation to execute the contract. Okay, it is decided that you are going to buy 100 US dollar. Okay, at the exchange rate of 80. Okay, I means you have a right to buy 100 US dollar at the exchange rate of 80. Okay, if tomorrow exchange rate is say for 75. Okay, so what you are going to do, and guess, means which one is the more beneficial? Means to buy 100 US dollar, here you need to spend 8,000, and here you need to spend 7,500. Which one is more beneficial for you? Can anyone guess?
75,000.
Yeah, correct. Okay, so this is basically the market situation, today's market situation. Okay, so and because you already enter into the transaction, and this is an option transaction, so it is not required for you to execute this transaction. Okay, and if you pay the premium of 2 rupees, okay, so how much amount you need to pay to buy 100 US dollar with this? It is basically the 78, sorry, 77. Okay, 100 US dollar. So you need to pay 7,700. Okay. Still you would be in a position to save 300. Okay. If tomorrow this exchange rate is 85, then what you are going to do? Now you need to compare this transaction with this one, because you already purchased an option. Okay. So here, if means at the current market rate, you need to spend 8,500 INR, and because you already have an option, so you can spend 8,000 only, which is more beneficial.
Then 8,000.
8,000, right? Okay, so what you are going to do here, you are going to execute option contract, and you are going to buy at a 80 plus 2 rupees premium, that means 82. So it is 8,200. Okay, so what happened here, there is a total saving of 300. It is a plus saving. Okay, so your maximum loss is basically this two. Otherwise you are always in a beneficial position. Okay, so means whatever may be the current exchange rate, and it will not affect, because you already lock your exchange rate with the option. Okay, if the current exchange rate is more favorable than option exchange rate, then you can go with the current exchange rate. You do not require to execute the transaction. Okay, and if the current exchange rate is adverse, adverse against your option exchange rate, then you can execute the option contract. Okay, so this way you can save your money. Okay. So in exam, you may get the question, I mean, this kind of MCQs you will get it. And just keep in mind, in an option, always the option buyer losses restricted to the premium amount. Okay. Underwriter has an unlimited loss. Okay. Only the buyer is under an having an option, but for the underwriter, means the other party, he is always under obligation. So that you need to keep in mind, and that happened only in case of an option, not on forward or future. In forward and future, both the party under obligation. Okay, so their losses depend on the situation and unlimited. In an option, only option buyer has an option whether to exercise the contract or allow it to lapse it. Okay, so that's why his loss is restricted to whatever the premium he is paying. Okay, underwriter loss is basically unlimited. Are you able to understand all this terminology? I'm just writing for forward. Both the party are under obligation. Okay, so hence loss of both party are unlimited. Why loss happened? Because I predict the exchange rate may increase, and but the actual situation is the exchange rate get decreased. So that's why the loss may arise. Okay, future, the same thing. Both parties are under obligation. Obligation, and loss of both the parties are unlimited. Unlimited. What is the difference in future and forward? Actually, forward we are using for a bigger transaction. And it is basically over the counter. Customized solution, then customized contract. Okay, and in future, standard contract deal in a exchange, and mostly used for small contract. Okay, then the option. Okay, buyer of the option, whether it is a call option, put option, is not under obligation. Okay, so that's why his loss is limited to premium amount. Okay, and then seller, we called it as an underwriter because he is taking a risk, are under obligation. Are under obligation. Okay, so if he is under obligation, that means his loss is unlimited. Okay, so that this 2-3 things you just need to keep in mind. So we can see the example. Getty International owns its Mexican supplier 1 million pesos during 30 days. Although the pesos is currently exchanged for the US dollar at 0.08, the company is fearful that Mexican peso will strengthen in comparison to the dollar before the settlement to as much as 0.10 Getty. Okay, so Getty International pays a 0.005 option premium to secure a call option to 1 million pesos in 30 days for 0.008 pesos. So it is basically what is the party's obligation to pay 1 million pesos. Okay, and the current exchange rate is 0.08. 0.08. So how much US dollar need to pay then? It is 80,000. Okay, and this is my option price as well. Option price. Okay, then how much premium I paid to buy this option? 0.005 multiplied by 1 million. So it is basically the 5,000. Okay, so this amount we calculate 1 million multiplied by 0.005. Okay, so it is 5,000. So total amount payable is 85,000. Okay, if I am not enter in the option contract, and the exchange rate is as per prediction, so how much I need to pay? 1 million multiplied by 0.10, which is given here. Okay, so that is 100,000. Okay, so if this is the scenario, then I may need to incur a loss of 15,000. Loss of 15,000 US dollar. Okay, but because I have an option, so I can execute the contract at a 0.008 exchange rate, and I can fulfill my obligation with 85,000 US dollar. Means 80,000 I need to incur. I need to incur to buy 1 million pesos, and the 5,000 which I paid the premium. So still there is a benefit of 15K. Okay, so this way we need to calculate. If you see here, spot rate at settlement, means whatever may be the predicted, which is 1 million, and option price is 0.008, and then I need to add the premium. So total option price is 85. So 85,000 is if I execute the option, and I'm able to save the 80,000, 15,000. If you see, so this you need to keep in mind. Okay, 0.10, this is basically we are taken from here. 0.08, it is exchange rate given here, and then the premium amount which is given here. Okay, so option plus premium, that is my total conversion cost. Okay, and this is my the spot rate which I need to incur if I am not go with the option. Okay, so that amount is more, this amount is less. Okay, so the profit is 15,000, saving is 15,000. Any doubt here? Okay, the same example we will take, but it is basically other side. Means right now there is we are in under obligation to pay 1 million pesos. Now we are receiving a 1 million pesos. So how this mechanism work for a receivable? Okay, so in payable, if foreign currency strengthen, then it is an issue for us. Okay, and in receivable, if foreign currency weaken, then an issue for us. Okay, so that also you need to keep in mind. So 1 million pesos I supposed to receive, and the exchange rate is 0.08. Okay, so how much I am supposed to receive? 80,000. Okay, but it is expected that in future the exchange rate is 0.06. Okay, so in means like foreign currency is a same amount. Okay, but because of my exchange rate, okay, we can, I supposed to receive only 60,000 US dollar. Okay, so to mitigate this loss, what I'll do, I'll book my exchange rate or option price within 0.08. Okay, so again, like means what is my net receivable? See here, I am getting a 0.08 as an exchange rate. Okay, and then the 0.05 is my premium. Okay, so what is the receivable for me? Anyone can guess it? Means what is the receivable exchange rate for me?
0.075.
Yes, 0.075, correct. Okay, why? Because this is my gain or receipt. Okay, and this is my charges. So I need to deduct here. That also you need to keep in mind. If I'm paying, so this receipt may change to payment, and that's why the premium need to add, because premium anyhow I'm going to pay. Okay, but in case of the receipt, that I need to deduct from the exchange rate, and we need to consider the net conversion exchange rate is 0.75. Okay, so again 1 million, if I go with the option, I need to multiply it by 0.75, which may give me 75,000 US dollar. Okay, and if I wait, I am not going to enter in an option contract, and the current exchange rate would be the 0.60. So in that situation, I may receive 60,000. Okay, so 75,000 I'm able to receive if I enter into an option exchange contract, which is a higher amount. So here the net saving of 15,000. Okay, saving of 15,000. So that is basically the option. Okay, so in this option for receivable and payable, while calculating the option price in receivable, you need to deduct the premium. In payable, you need to add the premium. Okay, and the second point, if the foreign currency strengthen, okay, if the foreign currency strengthen, okay, so in that situation, it is basically loss to us. Okay, because my local currency get reduced. Okay, and that's why I need to receive a less amount. Okay, and the if the foreign currency weaken, then it is basically loss to us. Okay, means
Hello?
if the foreign currency weak, then yeah.
So as per the example, we have paid premium of 0.05
Mhm.
and the exchange rate is expected to decrease by 0.6 something in this example.
Correct.
Yeah, but after paying the premium, the expected 0.6 will be fixed or it may vary also.
No, no,
Because that is the
no, no.
expected.
See, here the 0.06 is basically the prediction. That could be vary. The fix is 0.08. This 0.06 is prediction that could be vary. Fix is 0.08 only.
So
And
after paying the premium also, we are not sure that it may go to at least 0.6.
this is the market rate. So we are not sure. In any situation, to
Okay.
protect this fluctuation, we need to lock a rate with this, means the option rate.
Okay, sir.
Okay, so it may possible today I am predicting it could be the 0.06, but it may possible it is 0.10. That is okay. So in that situation, you are not entering into the option contract, or you are not going to execute the option contract, because you are getting a more money with the spot exchange rate.
So,
Okay, so the settlement rate or the spot rate, that could be vary. You cannot keep a control over it. What you can do, whatever may be the fluctuation or uncertainty arises, that you can protect by enter into the option contract.
Sir, I have a doubt.
Yeah,
Sir, in the payable one in which you have written, you have told that if the foreign currency weakens, it's lost to us. But because we are paying, if the foreign currency weakens, won't it be good for us because we'll have to pay less?
if the payable for if the foreign currency weaken, yeah, it is reversible. Correct. Yeah, if the foreign currency strong, if the foreign currency weaken, then I can buy the more foreign currency. Yeah, it is profit to us. Correct. Yeah, if the foreign currency weak, then I can buy more foreign currency with the same exchange rate. Okay, so in that situation, it is a profitable for me in case of the payable, and I can pay my obligation with the less domestic currency. And the reversible is if the foreign currency is strong, then at the time of receivable, I may get I can convert like I can get the more domestic currency. Okay, so that's why it is profit to us. Yeah, correct. Okay, so here the logic is, means I'm giving the like math like number in a number format. If today 1,000 US dollar, okay, it is I can buy at an 80,000. Okay, means the exchange rate is 80. Okay, if the exchange rate is 85, that means the foreign currencies are stronger. Currency strong. Okay, so for buying 1,000 US dollar, I need to spend 85,000. Okay, if I'm buying, that means I'm paying. So there is a payable of 1000 US dollar. Okay. So for that, it is 5000 is basically lost to me. So in case of a payable, when the foreign currency is strong, okay, we need to bear the loss. Yeah. So foreign currency is weak, then we need to, we can get the profit. Okay. And the same way, like if I'm getting an 1000 US dollar with an 80 exchange rate, I may get the 80,000. No, just on it. 1000 US dollar if the 80 is the exchange rate. This is the loss. Okay. Yeah. So it is the profit for me. 5000 profit. Okay. In case of the receivable, if the foreign currency is strong, so I'm getting a more domestic company currency. Domestic currency. So in that situation also, I'm getting a 5000 profit. Okay. So like we will revise here. So if the in case of the payable, if the foreign currency weaken, then the profit to me. In case of the receivable, if the foreign currency is strong, then it is profit to me. Hmm? Are you able to understand? Means like for buying an 1000 US dollar, earlier I need to spend 80,000 INR, but now I need to spend 85,000 INR because the foreign currency is strong, and that's why I need to bear the losses. Okay. So if I'm buying 1000 US dollar, that means it is for the payable. And here I am selling 1000 US dollar. I am receiving from the customer 1000 US dollar. But if today I am selling it, I can receive the 80,000. But if after 3 months, if I am selling it, then I can receive the 85,000. That means the foreign currencies become a stronger. So in that situation, I am getting a profit. Yeah. So any issue, any doubt till now? Okay. Then long-term forward contract. Okay. So it is the more or less same. Okay. So long-term forward contract deal with the same issues as any other forward contract, and long-term forward contract are set up to stabilize transaction exposure over a long period. So long-term purchase contract may be hedged with the long-term forward contract. Okay. See, in future, it is generally a standardized contract and for a short period, but forward contract, it is a customized contract, so you can extend the period as well. Okay. So that is basically the long-term forward contract. Currency swap. Say for in swap, basically there is a series of transaction. Okay. So say for, I mean, there is a EMI, monthly EMI, which is for a 60 month. Okay. So in that situation, like there is a one US entity and Indian entity. US entity want to invest in India and Indian entity want to invest in US. Okay. So if the Indian entity want to invest in US, so they need, their requirement is US dollar, and they want to invest in India. So that's why their requirement is INR. Okay. But if they invest, means they take a loan or transfer the money in India, then they need to convert it. So what both the party can do, like US entity may take a loan in US dollar, an Indian entity may take a loan in INR. Okay. And the both are going to swap their obligation. Means whatever may be the installment in INR. I mean the first they exchange the principal, say for the 100,000. Okay, which is basically the equivalent to, if I consider the exchange rate of 80. Okay, so it is basically the equivalent to 8,000. No, I'll consider here 8,000, not here 10,000 I'm considering, and which is equivalent to the 8 lakh. Yeah, 8 lakh. Okay, so what happened? This 8 lakh loan taken by the Indian entity, which given to him, and the 10,000 is US dollar, whatever may be the loan taken by the US entity given to the this party. Okay, so 800,000 carries the monthly obligation of, say for in ex say for 1033, and here say for 166 US dollar. Okay, so this 166 US dollar on monthly basis paid by this party, sorry, 13,333 INR, which is paid by Indian party on a monthly basis, and 166 EMI, this is paid by the US party. Okay, so what they are going to do, they are exchange their money, like 10,000 and 800,000. This could be the 80 rupees exchange rate, and here whatever may be the 33,000 and 166,000 obligation arises in their domestic currency, they are also going to pay for this. So for 10,000 US dollar, the EMI is 13,333, which is again converted at an exchange rate of 80. Okay, so if you can see, whatever may be the 166 could be the EMI or the principal repayment that the Indian entity is supposed to do in US dollar. For that, he is going to pay 13,333. So this exchange rate is again 80. So for their series of transaction over the period, the exchange rate get blocked. Are you able to understand what they are doing here? The Indian entity need a 10,000 US dollar, and the US entity need the 8 lakh rupees INR. Okay, so what they are going to do, they are taking a loan in their domestic currency and then exchange this loan. Okay, and whatever may be the whatever may be the exchange rate, whatever may be the EMI in a local currency, that both the parties are bearing it. Okay, so whatever that principal exchange rate, that applies to all EMIs. So this way they can protect the increase or decrease in exchange rate. Okay, are you able to understand? Any doubt here? If like say for the Indian entity took the loan in a US dollar, okay, then and he need to pay the EMI in US, okay, to buy this 166.67, sometime he need to use the exchange rate of 80, sometime 82, sometime 85, whatever may be the current, and sometime even 78. Okay, so whatever may be the changes in exchange rate, that he need to apply. But because of swap transaction, whatever may be the 10,000 US dollar he took, okay, for that he need to pay in an INR, in a domestic currency, like 13,333. So always with respect to EMI of 166.667 US dollar, the exchange he need to against this EMI obligation, he need to pay the 13,333 fix. So that's why his exchange rate gets locked in this situation. Are you able to understand? Any doubt here?
Whenever he's paying EMI, the fixed US dollars would be 80.
Whenever yeah, because he is paying in an INR. Okay. Because see, he even though he took a loan, enough means he exchanged his INR loan with the US loan, but he is paying in an whatever may be the installment. Okay, he is paying in an INR, so he do not require to buy the US dollar to pay the installment. So it will not affect the exchange rate, and this way the exchange rate is blocked.
So,
Any point?
so what if one person becomes default in paying the dues?
Yeah, so that is the separate case actually. So in that situation, because see, already he received the money. I mean, he took a loan in INR, the Indian entity, okay, and he gave the money to the US dollar, and US person gave the money. US person gave the US dollar to the Indian entity. The transaction is closed at that level. After that, if the US person is making any default, so that is his own issue actually. So it will not affect the transaction. This may affect in a interest rate swap, but not in a currency swap. Means the swap is also of two types.
So Indian will not bear any dues from the US.
Yeah, after once they exchange their currency, their transactions are completed.
Okay, sir.
Okay, so further default from any party will affect to that party only. The only thing is that even though he took the loan in a US dollar, his installment is fixed in an domestic currency. Okay, so that's why there is no impact of difference in exchange rate. Future impact on difference in exchange rate. Any doubt here? Okay. Then, yeah, that already we discussed two form parallel loan. Okay, we can take this example. In order to hedge its future raw material purchase for its operation in Poland, a US manufacturing firm, US counterparty, agrees to enter into the currency swap with a Polish multinational firm, foreign counterparty, whereby the US counterparty agrees to provide the following quarterly notional amount in US dollar to foreign counterparty in exchange of the following quarterly notional amount in Polish zlotys. Okay, zloty. So US counterparty receives 1.5 million zloty, 900 zloty, and 750 and 180. Foreign counterparty receives 500, 300, 250, 600. Assume the exchange rate is 3.25 zloty for 1 US dollar at the end of the quarter one. Calculate the US dollar from foreign currency gain or loss recorded. Okay. So here, I mean, this is basically the series of transactions which the US counterparty supposed to receive and the foreign counterparty supposed to, yeah, supposed to receive. So in that situation, if the current exchange rate is 3.25, okay. So here, if you can see, everything is with the exchange rate of 3. Like all, I mean, 3 times. Okay, 3 is a 9, 5 3 is a 15, 2.5 multiplied by 3, it is 7.5, 6 multiplied by 3, 1.8 or 18. Okay, and the current exchange rate is 3.25. So if I go with this transaction instead of 3.25, okay, so what is the situation? You can see. The US manufacturing enter into a fixed notional amount currency swap and foreign counterparty when the exchange rate was 3 zloty for 1 US dollar. Because the contractual quarterly payment made in US dollar to Polish firm are fixed at the exchange rate throughout the swap, any movement up or down of this two exchange rate will result in foreign currency gain or loss. So in the first quarter, the US dollar appreciate versus the Polish zloty. So the US counterparty incurs a foreign currency loss. Under the terms of the currency swap, the US counterparty pays 500,000 US dollar and receive 1.5 million zloty. Okay. So in that situation, the US party can get 500 US dollar. Okay. But if he exchange with the current market, then he may get 461, 538. Okay. So it is better to enter into the transaction with the third party. Okay. Instead of exchanging the currency in an open market. Okay. And this may give the saving of US dollar represent a paying US dollar and receiving a zloty of $463 represent a loss of 32. Just a minute. Paying 500 US dollar, 1.5 million. Loss of 38,462. How it is a loss? Okay, sorry. So, yeah, the foreign counterparty receives 500. But if he exchange the 1.5 million with a 500 US dollar, that will be the beneficial.
The dollars are appreciating, sir.
No, I'm not thinking in that way. See, like the US US counterparty, okay, or the US party, if he receive 1.5 million and if he sell that 1.5 million to foreign counterparty at $500, okay, and here if he is able to get in an open market, he is able to get 461, 538. So it is better that he is supposed to receive the 500 US dollar. That's what I'm thinking. Like say for example, US counterparty receives the 1.5 million, okay, and now he want to sell this zloty, okay, so exchange rate is 3.25, okay, so if he is going to sell this zloty for 3.25 exchange rate, okay, so he can get the US dollar of 461, 538. But if he sell to the foreign counterparty, then he may get the $500. Okay, just a minute, let me read the question properly. No, okay, the question is something different. Okay, quarterly notional amount in US dollar to foreign in exchange of the following quarterly notional amount in the uh, Polish zlotys. Agreed to provide the following quarterly notional amount in US dollar So he is paying in a US dollar. Okay, the question is something different. So the US counterparty is going to, I mean, this is the decided exchange rate, and for that he is going to pay the US dollar, and against that, the foreign counterparty giving a 1.5 million zloty. It is like this. It is not the receivable. It is basically against 500 US dollar, the foreign counterparty giving a 1.5 million zloty. So that's why it is a loss. Okay, because in a open market he can buy the 1.5 million zloty at a 460, whatever may be the exchange rate, 461 538. Okay, and if he buys from the foreign counterparty, then he need to pay the 500 US dollar. Okay, so it is better he can buy in an open market. Okay, so it is loss for him. Okay, any doubt here? Okay, so can we take a break of 15 minutes? And then we go ahead. Okay, so I'll stop right now, and then we start at 9:30.
Okay, sir.
Yeah. Okay, so before we start to next topic, just to keep in mind, I mean, you need to read the question properly. Okay, if you misinterpret the question, then your answer is also get wrong. Okay, then mitigating transaction exposure, alternative hedging technique. Okay, so that is leading and lagging means either you can take a decision upfront, or you can wait to take a right moment. Okay, so leading and lagging represent transaction between subsidiary or a subsidiary and parent. The entity that is owed may bill in advance if the exchange rate warrants leading, or possibly wait until the exchange rate is favorable before settling lagging. Okay, so first thing, this kind of mechanism, okay, I'll first explain. Leading means you are making a payment in advance, and lagging means postpone. Okay, so generally this strategy we adopt where we have a control over both the entities. Okay, so that's why if you see between subsidiaries or subsidiary and a parent. Okay, so holding company can keep a control over their subsidiaries as well as the, I mean, the parent is they himself. Okay, so that's why this kind of mechanism we can adopt only for I mean if both the entities belong to the same group. Okay, so leading means making a payment in advance. Say for the one subsidiary need to make a payment to other subsidiary or the parent company. Okay, and it is expected that the exchange rate may be unfavorable. Okay, in a future. So what they do, they can make a payment in advance. Okay, the same way if they expect that the exchange rate may be better in a future, so in that situation they can postpone the sum payment. Okay, so that is basically leading and lagging technique. Okay, then cross hedging. So technique known as cross hedging involve hedging one instrument's risk with a different instrument by taking a position in a related derivative contract. Okay, so this is often done when there is no derivative contract for the instrument being hedged, or where a suitable derivative contract exists but the market is highly liquid. Okay, so like means let me think. Example of cross hedging. Just a minute. Say for if any product like if you can consider the example of oil. Okay, so there is a uh, palm oil and soybean oil. I'm just giving an example. Oil. Okay, so the what I mean what the company can do to protect the risk of prices, they do the transaction of this product. Okay, so what happened, I mean generally, like if I feel the prices of the palm oil may increase, so I book the order for the palm oil. Okay, But if I'm not able to get any contract or any underwriter who is ready to protect my rate for the palm oil, then I may enter into the contract with the soybean oil. Say for if palm oil prices get increased, the same sequence may be followed by the soybean oil. Okay, so that's why if I can get the forward contract for soybean oil, okay, so I will hedge the soybean oil prices to protect the risk of price increase of palm oil. That is basically the cross hedging. Okay, the only condition required is, I mean, when you are going for a cross hedging, you need to make sure the same pattern followed by the other commodity. Okay, so that you need to keep in mind. Means even if you see in the currency, generally euro and US dollar from India prescriptive, they follow the same pattern, euro and USD. Okay, I mean, just an assumption. Okay, if you are
It's
not
like a
able,
barter system, sir.
sorry.
Is it like a barter system?
No, it is not a barter system. Okay, in barter there is an exchange. It is basically how I can say, if you cannot hedge the particular commodity or particular currency, but you know the other commodity or other currency showing the same pattern. Okay, then you can hedge the other currency or commodity, whatever may be the price gain or loss arises in your principal currency or commodity, that you can knock off against the price, means whatever may be the hedge you did with the other currency or other commodity. Okay, so I'll take one practical example, numerical example. Okay, I'll continue this example only. Like the principal contract is palm oil. Okay, say for I need to sell 100 MT in 3 months. Okay, and and the price is 80,000 for palm oil. Okay, for soybean oil, the today's price is 85,000. Okay, okay. So if I book the future contract of soybean oil for selling at 85,000, okay, it is a future contract. Okay, what happened? The price of the palm oil get decreased and now it is a 70,000. Okay, current. Okay, and the parallel, as I said, the same pattern shown by the other commodity. So here also the price of the soybean oil also get decreased and now it is a 75,000. Okay, so what happened, I mean, how I am using the hedging technique, like now I can sell at a 70,000 in an open market. So there is a loss of 10,000 in a palm oil that I can save here, because I have an sell contract, future sell contract. Okay, so I can sell at a 85,000. I will buy from the market at a 75,000, and here I am able to make a profit of 10,000. So my 10,000 losses, okay, in a palm oil, okay, get compensated by the future contract of soybean oil. Okay, so what happened? This strategy we are adopt when we are not able to get the suitable derivative or hedging contract for a principal commodity or the principal currency. So what I do, instead of entering the hedging mechanism for that commodity or currency, I am going to hedge a commodity or currency which is highly correlated with the principal commodity and currency and following a same pattern. Are you able to get me? Any doubt here? See, this is the one of the toughest topic actually. Means I find most of the CA students are also not able to cope up with this. So, if you have any doubt or if you want to repeat any topic, I am okay with it.
So the prices may vary also, right?
Sorry.
Like in the example of palm oil and soya oil,
Hmm.
the prices got decreased.
Hmm.
It got decreased. It may increase also, right?
Yeah, same. But if it is an increase, then there is no issue. I mean, you can take another example. I mean, okay, that is also, if it is 80,000, 90,000, okay, so here there is a profit of 10,000. But then the corresponding loss happened here also. I mean, this will become also 95,000. So it is a 10,000 loss. In
No,
hedging,
sir, but they won't execute the future contract, right? Because anyways, it's the profit.
no, in a future is not an option. It is an obligation. So you need to execute the future contract as well. See what happened. I mean, sometime there may be a profit, sometime there may be a loss. The mindset of the entrepreneur or the person who want to hedge, he basically want to fix up his profit or loss situation. So he may not only in a option, he is only he may go with an unlimited profit in a option scenario. But if you see the future forward or the swap transaction, it is not like this. Okay, so it is just a fixation of the prices or the fixation of the profit or loss situation. Only in an option the profit is unlimited, because in option contract you can rescind the contract or you can means decide not to enter into the contract. That flexibility available in option only. But in swap, in future and in forward, both the parties are under obligation to execute the contract.
Okay, sir.
Okay, and this terminology also you need to keep in mind. Okay. Then currency diversification. So simplest hedge for a long-term transaction is to diversify foreign currency holding over a time. A substantial decline in the value of one currency would not affect the overall dollar value of the firm if the currency represent only one of many foreign currency. Okay. So like you need to see what happened. If you are holding multiple currencies, so you need to because in one currency may go down and the one currency may get up, and the correspondingly one currency may go up. So in that scenario, it is basically the kind of natural hedge. So dollar value may not get disturbed here. Okay. So generally, what happened, like we saw, euro may become a stronger and INR may become the weaker. But if I maintain the 50% euro and 50% INR, so my total valuation in dollar may be the same. Okay. Uh, Anyone know the euro trend nowadays? Euro trend in last 6 months. Mm, uh, Euro to INR. Do you have any idea? Jan, say for 89, Feb 92, March 95, April 97, May and June. 99 and today 101. So from 89 to 101, okay, 89 to 101. See, almost in the last 6 months, the valuation of the euro strengthened by 10%. Okay. So, I mean, how it will impact to the like the foreign financials? Anyone can guess? I mean,
You have to pay more amount to purchase the commodity.
correct. You need to pay the more amount, so your expenses get increased, okay, which you cannot control, okay. Even if say for like you have a credit period of 6 months, okay, so whatever may be the purchases you did with an exchange rate of 88 89, now you need to pay with a 101 rupees, okay. So because of that reason, valuation of the Indian entity or the entity which paying in a foreign currency or in euro, okay, their business valuation may go down. Okay, so it is basically a risk of loss, economic loss for those entity. Okay, so this is basically the you need to assess the economic exposure. Okay, so we need to see illustration 16. So Petes Primo Pintas manufacturers Pintas in Mexico. The company's expenses paid to local suppliers are denominated in pesos. The company export nearly 80% of its product to United States and receive a revenue denominated in US dollar from upscale Mexican theme party planners. If the pesos were to strengthen in relation to the dollar, then the import revenue could be significantly less than the domestic expenses. Okay, and the Petes Primo Pintas would suffer economic losses as a result of its economic exposure to exchange rate risk. So I am giving an example in terms of the payable, and here the in an illustration it is basically the in terms of the receivable. Okay, but the thing is here the foreign currency, in my example foreign currency become an strengthen, and this example foreign currency become a foreign currency basically become the weaker. Means the pesos were the strengthened. That means the local currency is strengthening. Okay, and the US dollar become the weaker. Okay, so whenever there is a change in exchange rate, okay, so it will affect to your economic losses. Okay, so I mean in today's scenario, if you see in India, euro is strengthening exceptionally, and because of that reason, every Indian entity who generally import from the European countries, or whatever the purchase transaction they did in a euro, they need to suffer. They need to suffer an additional loss of 10%. Okay, so that is basically the economic losses, or we need to see means what could be the economic impact because of change in exchange rate. Now, how we can mitigate this situation? Restructuring. So, means the first structure is basically, instead of entering transaction in foreign currency, you can use domestic currency. Okay, so economic exposure to currency fluctuation can be mitigated by restructuring the source of economic and expenses to the consolidated entity. Decrease in sale. A company fearful of depreciating foreign currency used by a foreign subsidiary may elect to reduce a foreign sales to prevent the cash flow. Okay, so in this situation, what happened? Like the foreign subsidiary, they can minimize their foreign sales. Okay, if they find that they are not able to convert whatever may be the foreign currency they receive with an equivalent domestic currency. Okay, so in that situation they need to reduce it. And the same way, increase in expenses. A company anticipating a depreciating foreign currency may elect to increase reliance on those suppliers to take advantage of paying for raw material or supplier with a cheaper currency. Okay, so this way we can restructure. Okay, so the first is basically use the domestic currency. Second, we need to use the supplier where we need to utilize less domestic currency. Okay, and say for means like you can consider an example. If the like Indian subsidiary, okay, so they need to bill to the US party. Okay, and what happened, the US party may give US party, means it is expected that the US dollar may be US dollar may be weakened. Okay, so in that situation, it is basically a loss to the US Indian subsidiary. So what they can do, they can instruct to the US counterpart, their US parent company, they can bill to the US party, and whenever the exchange rate is favorable, in that situation, the parent company can bill to the Indian party. So this way also you can rotate the transaction, depend on the expectation of the foreign currency appreciation and the decline. Then characteristics of the restructuring and economic exposure. Restructuring tend to be more difficult than ordinary hedges. Economic exposure to exchange rate fluctuation are viewed as more difficult to manage the transaction exposure. Okay, so see, whenever you are going to restructure something, okay, you need to evaluate whatever the rules and regulation applicable. Okay, say for it is, for me it is very easy to say that the US parent company can bill to the foreign US customer of the Indian subsidiary. Okay, and they can postpone the billing to the Indian subsidiary. Okay, but as per the accounting standard, this is not an acceptable. So the restructuring is not so easy like in transaction hedging. Okay, so you need to evaluate so many things while doing any kind of restructuring. Any doubt here? In transaction restructuring or the economic exposure restructuring, there are lots of permutation combination available. Okay, it is not, there is no any standard process or some guideline. Okay, means like in normal transaction hedging, you can go with the forward, future, option, or the swap. Okay, but in a economic exposure mitigation, first you need to have a control over the both the transaction party. If you don't have a control over the transaction party, at least some part, Indian subsidiary, US parent company, they should have a they should under the same management. Okay, this is the first aspect, so that you can hold or you can lag or lead the transaction. Okay, the second aspect is basically you can correctly predict, because here the three currencies involved. Sometimes if the end customer in Europe, okay, so in that situation there are the three currencies involved. So you need to assess the impact of each and every currency. Okay, and rules and regulation also, that also you need to evaluate before any restructuring. Whatever may be the reporting practices, that also you need to understand. Okay, so it is not so easy, but again there is a mechanism or there is a certain so many permutation and combination which you can utilize to reduce your losses. Like say for in this situation also you can think, the European exchange rate come from 89 to 101. Okay, but if we have a parallel receivable at the parent end, so what they do, they can like whatever may be the European euro receivable, they can apply payable of Indian subsidiary. Indian subsidiary. Okay, and and they can raise a corresponding US dollar invoices. US dollar invoices. Okay, so invoices or convert euro receivable to US dollar receivable. Okay, there is no fluctuation at this moment. There is no that much fluctuation in a US dollar. This is only the fluctuation in a European. Sorry, euros. Okay, so that's why this way also you can manage your economic transaction. Any doubt here? Anything you need to discuss or any point which you feel, or you can give some example as well.
Sir, in case of economic exposure,
Hmm.
in real life example for like Tata, they have major subsidiaries in many other countries.
Yes.
So, if there is, as we said, discussed in economic exposure, we have to decrease the sales in foreign, and we have to upgrade the local currency.
Yes.
We have to increase.
Yes.
Yeah. So if there is any increase or decrease in the other countries' currencies, how will the Tata deal with other countries along with the products?
Okay, I tell you something. See, in case of the Tata, they have a multiple subsidiaries, say for China, India, US, Europe. Okay, and the China may have a receivable of US dollar. Okay, India may have a payable of US dollar. Okay, so it is, they can, what they do, they enter into the transaction at the same time, means when they receive the US dollar, that they apply to the Indian payable. So that this way they can manage their economic exposure. Okay, this is one aspect. Second aspect, decrease in sale from one country. Okay, what they are doing, they are not delivering the material to the customer. What they are doing, instead of doing a sale from India, they will execute the sale from the Europe. Okay, so what happened? India euro currency, there is a huge fluctuation in India euro. but there is no much fluctuation in US dollar and euro. Okay, so what happened, instead of I mean, in case of the payable, instead of buying from directly buying from Europe by Indian entity, what they do, they place the order on a US entity, and US entity buying from the Europe, like this. So this way we need to manage the economic exposure. Are you able to understand? But for that, the basic requirement is there are 4 5 entities which should be controlled by the one person. Then they can manage the economic exposure.
So,
Okay. Then like market influences on business. So here most of the part is related to the economics. So we know the means while my macroeconomic focuses on human behavior affect outcome in highly aggregated market, example product labor, microeconomic focuses on how human behavior affect the conduct of more narrowly demand unit, including single individual household or the business firm. Okay, so what we are doing, we are thinking from the point of view of consumer. Okay, microeconomics. Okay, now the demand curve illustrate always x-axis represent the price and the y-axis represent the quantity. Okay, so demand curve illustrate the maximum quantity of goods that consumer are willing and able to purchase at each price. Okay, so if price is less, okay, so whether we are sell to high quantity or whether we can sell low quantity. Can anyone tell?
Low quantity.
No, high quantity. If the price is less, then you can afford the more quantity. Price increase, the quantity get drop. Okay, so your demand curve is always like this. Okay, so this is demand curve. Okay, so this demand curve is micro demand curve in certain way or not the total demand in the economy as a whole. Okay, so it is basically for the particular product, that also you need to keep in mind. Okay, quantity demanded is defined as the quantity of a goods or service individual are willing and able to purchase at each and every given prices, all else being equal. Okay, so see, if the brand value is not affected or other factors are not affected, then this concept is okay. Means with every increase in price, there is a decrease in quantity demanded. Okay, that's why it is given all other else being equal. Means the other factors will not impact much. Okay, like iPhone, even if the price of the iPhone get increase, there may be a demand may not get decrease. Okay, change in quantity demand move along the demand curve. A change in quantity demanded is change in the amount of goods demanded resulting solely from change in prices. Okay, just because of price change, whatever may be the impact on the quantity demand, okay, that we are reflecting. So here it is x-axis we plot the prices, y-axis we plot the quantity. Okay, and every increase in a price, the demand for the quantity get decrease. Change in demand, a change in demand as a change in the amount of goods demanded resulting from the change in something other than the price of the goods. A change in demand cannot be due to a change in price. A change in demand causes a shift in demand curve. Okay. Now what happened if the other factors impacted? Okay. So on this price, not because of price, but the quantity demand get decreased like this. With this price again this, with this price again this, with this price again. So here there is a new demand curve. So demand curve shift from right to left because of other factors. Okay, say for if we come to know the particular product which we are buying is not fit for the health. Okay, I mean it will not impact much, but at very less level it is impacted to the health. Okay, so health conscious people may not buy it. Okay, and if they are not buying it, so one set of customer, I mean the product, one set of customers started to stop to using those product. Because of that reason, overall demand get decreased. Okay, so I mean if the demand get decreased or there is a change in demand because of the factors other than the price, then there is a shift of demand curve. Okay, this change in demand is not because of price, it is mainly because of other factors or factors other than price, and because there is a change in demand curve. Are you able to understand till now?
Yes, sir.
Okay. So fundamental law of demand state that the prices of the product or service and the quantity demanded of the product or service are inversely related. So inversely related means if price increase, what is the impact on quantity demanded? Where I put the arrow?
Decrease.
Sorry?
Decrease.
Decrease. Okay. So this is basically the inversely proportional. Okay. Then substitution effect. So substitution effect refers to the fact consumer tend to purchase a more or less of a goods when the price fall or rises in relation to the price of other goods. So substitution effect exists between the people tend to substitute one similar goods for another when the price of a goods they usually purchase increase. For example, if the price of Pepsi decreases, it will be used as a substitute for Coca-Cola. Okay. So what happened again? I mean, this is also the this is the original situation. And in case of the Coca-Cola also, okay. Now what happened? Price of the Coca-Cola get decreased. Okay. So if the price of the Coca-Cola get decreased, means this one, okay, this one, and then this is the quantity, or the quantity may increase. Then this one, this is the quantity, this one, this is the quantity, this one, this is the quantity, and this one, this is the quantity. So demand curve shift to right. Okay. Total number of consumer base are constant. Okay. So in that situation, what happened? If the people started to use the Pepsi, that means it will affect the Coca-Cola demand. So it is when the demand curve of the Pepsi gets shifted to right side, it will impact it to the demand curve of the Coca-Cola, and automatically the demand for the Coca-Cola gets shifted to left side. So there is no change in any condition for the Coca-Cola. They have not reduced the prices. There is no impact on other factors. Okay. Still, because of prices decreased by the Pepsi, some of the consumers shifted to the Pepsi, and because of that reason, the demand curve of the Coca-Cola shift to the left side. Okay, so that is basically the substitution effect. Means the change in prices of one commodity impacted to the demand of the other commodity. Okay, so that is basically the substitution effect. Then income effect. So income effect means that the prices are lowered with the income remaining constant. Okay, so people will purchase more or all of the lower price product. For example, a decrease in prices of a good increases a consumer real income even when the nominal income remains constant. As a result, consumer can purchase more of all goods. Okay, so you can think in a this way. Okay, so prices of the some product get decreased. Okay, and because of that result, consumer can save and he can afford other product, afford more luxury product. Okay, so you can consider the quantity, a price, or we will take the example of car. Okay, so this is basically the first, second, third, fourth. Okay, this is the original demand curve. Now, because the consumer have a more savings, okay, because the prices of other product get decreased, so they have a surplus money, they can bear the car EMI. Okay, so in that situation, the demand for the car get increased, and again there is a shift of demand curve towards right side. Okay, so because of the income or the surplus money increases with the consumer, the demand for the luxury product may get increased. So now we need to see the factors that shift a demand curve. The first is wealth. Okay, so if a positive or negative change in wealth for a people will result in shift in demand curve. Okay, so if the people become wealthier, it may shift their demand for a luxury item, which we just discussed. Then changes in the prices of the related goods. So it is substitutes and the complement both. Okay, substitute we already discussed. Complement. Okay, so here they gave an example. If the prices of the computer fall, okay, so in that situation, more and more people buy the computer. As they buying the computer, they need to buy peripherals. Peripheral. Okay, because it is the complement with the computer. Means like if you're using the computer, then you need to use some peripheral as well. Okay, as the computer demand increases, okay, automatically peripheral demand also get increases. Peripheral means you can consider the speaker, keyboard, okay, that also get increases. Okay, so when there is a demand increase of a particular product, okay, correspondingly the demand of other product also get increased because of increasing demand of a particular product, then we can consider this as a complement good. Okay, and if there is a demand for a particular product increases which will impact it to the reduction of the demand of the other product, then it is a substitute. So when there is a directly proportion, means demand of one product increases, it is directly proportion to the increase in demand of other product, that means it is complement. And if the demand of one product increases, it leads to the decrease in demand of other product, that means it is a inversely proportion. So in that situation, we need to consider these goods as a substitute. So are you able to understand the complement and substitute?
Yes, sir.
Can you give two to three example for complement and two to three example for substitute?
Television,
Sorry. Yes.
television. We get complement as a remote, and the substitute is the other
TV and
company's
yeah,
television.
remote. Correct.
Sony and LG is just a substitute.
Yes, competitor are always subsidiary. A substitute. Second,
Car and petrol as a
yes,
complement, or
car and petrol.
tea and coffee as a substitute.
Tea and coffee substitute. Yeah. One more example. Mm. Any guess? For substitute petrol car and EV. If the people started to electric vehicle, they started to discontinue with the petrol car. So demand for petrol car may get decrease because of demand for EV car get increase. Okay. And in complement, mobile and accessories or even app you can see. Okay, right now, I mean, you saw so many app on a mobile. So if you're using a mobile, automatically demand for app get increase. Okay, so this is basically the substitute and complement. Then changes in consumer income, as we already discussed, any increase in consumer income will shift the demand curve to the right because they can afford a more quantity of the product with the same prices. Okay. For example, the employment in local community is primarily retail based because employee commission raise during the Christmas season. Those employee will have an additional consumer income and will demand more goods. Okay, so demand curve shift to the right. Means say for like earlier, means you may go for a hotel once in a means the price is less. Okay, so 4, 3, 2, 1. But now with this price, you may afford to go 6 days in a month. With this price, you are afford to go 4 days, 3 days, and 2 days. So it is basically the shift of demand curve to the right because you have a higher income. So you have a surplus money. Okay. So in spite of there is no change in the price. Okay. Quantity demand may increase. Changes in consumer taste or preference for a product. Okay. So when consumer preference taste for a given product increase or decrease, there is a shift of the demand curve. For example, if the in a clothing industry experience a revival of 1960s era, the demand for bell-bottom jeans, retro clothing will increase, and this also depicted as shift from the D1 to D2. So in earlier days, like people when started to shift to the bell bottom, bottom. So earlier maybe the demand is this, but now because most of the people started to shift to the bell bottom, they started, I mean the demand for this particular prices may go like this. So it is basically the shift of right. Okay. So it is basically what happened in this scenario. Earlier they have a limited customer base. Now the customer base increased. So because of that reason, demand for the particular product get increased. Changes in number of buyers served by the market. Okay, so if in a particular community there is a lots of old age people, then the demand for a product for a related to the old age people is high. Okay, but when this I mean the number of buyer served by the market is basically change, means from old age people to the teenagers, so the demand for the product related to the old age get decrease, and the demand for the product related to the teenager that get increase. So increase in number of buyers will shift the demand curve to the right. This evident in a community which there has been a steady rise in a population of people 65 and older. As the number of senior citizen grows, there will be more buyer of the prescription drug, resulting in a shift in the demand curve to the right. So whenever there is a increase in demand with respect to the same price, then the demand curve shift to the right side. And when there is a decrease in demand with respect to the same price, then the demand curve shift to the left side. You can see the example. Price, quantity. So this. So at this price, if the demand increases, then it go to this, this. So if the demand increases, then the curve shift to the right. But the price is same, but demand get decreases. Then it is shift to the left. If the demand decreases with a particular price, then the demand curve shift to the less. So you can see the change in quantity demanded versus change in prices. Okay, so change in quantity demanded with respect to change in price, then it is a straight line. Okay, but if there is a change in demand due to the factors other than price, okay, so then there is a shift of in right or left side of the demand curve, other than the price of the good, that you need to keep in mind. Okay, so if only because of price is affected, then it is in a same line, but other than price factor, then it is a right or left. Any doubt here? At this price, how much we can supply? Quantity. This is price. This is quantity. Are we supplying the higher quantity or lower quantity? If the price is low.
Low quantity.
Yes. If the price is low, then for supplier, they are not inclined to supply more quantity because they may get a less margin. Okay. If the price increases, okay, means the customer price increases, then they can supply more quantity. Okay. So this is basically the demand is something like that, supply is something like that. Okay. So the supply curve illustrates the maximum quantity of goods that seller are willing and able to produce at each and every price, at any given price, all else being equal. Means your cost not get changed. Okay, but the price is increasing. Okay, if the price is increasing, cost is not get changed, then you can generate a more profit, and you are willing to supply, willing to give more supply. Are you able to get me? Okay. So I mean at a particular price level, how much quantity we are going to sell? Okay, so that will I mean on that basis we need to plot a supply curve. Okay, quantity supplied. Quantity supplied is the amount of good that producers are willing and able to produce at each and every price, all else being equal. So this is basically all the quantity supply. Changes in quantity supply. So movement along with the supply curve. With respect to price, if there is a change in the quantity supply, okay, then it moves to one curve only. There is no shifting. But change in supply, a change in supply is the change in the amount of goods supplied resulting from a change in something other than price. Okay. So if like there is a ban on a particular product, or if you find there may be an health issue, so demand get decreased, and because of that reason the supply also get decreased. Means at particular price, okay, supply quantity supplied is get decreased. Okay, or if supplier feel they cannot generate a sufficient profit, okay, so in that situation also they need to restrict their supplies. Okay, so for example, if there is an additional taxes for a particular product, manufacturing of a particular product, so in that situation the cost may get increased. It is not the sell price of the customer get affected, the cost of the production get increased. If the cost of the production get increased and you're not able to maintain the sufficient profit, then what your next step, you may not ready to supply to those customer who expect a more credit period, because your risk is high. So in that situation you are if you stop the supplies to your risky customer, in that situation your supply requirement is less, and then it shifted to the right side. Okay, so if there is a decrease in supply, okay, for a factors other than the price, in that situation the supply curve shift to right. In case of the demand, it is exactly opposite. If there is a decrease in demand for the factors other than the price, then it shift to the left. Okay, so it is exactly opposite statement. In case of the supply, if there is a decrease in demand for the factor other than the price, then the supply curve shift to the right. But in case of the demand curve shift to the left. Now we need to see the factors which affect the supply curve. So change in price expectation of the supplying firm. Okay. So if the price are expected to decrease, the firm will supply more now at each price level to take advantage of the currently higher prices. For example, coffee product in produces gourmet coffee in can and sold primarily to the restaurant industry. Given expected favorable crop and market condition, the company believes that the average price of the gourmet coffee will decline by $1 a can in next 6 months. Based on the forecast, the company will increase the supply of gourmet coffee now to maximize the profitability. This is represented by shift in supply curve from S1 to S2. Okay, so if there is a change in price, which may be which may be good for the which may be good for the supplier. Okay, so there in future if the price get dropped down, that means like how I can say, the prices of the end customer, okay, that also get down. Okay, so that's why they every supplier want to sell the product as much as possible in a current period when they are able to get the higher margin. Okay, and because like they are willing to supply higher quantity with the same prices, okay, so it demand curve shift to the left. Supply curve shift to the left. Are you able to get me? Means you need to understand this example as well. The company believes that the average price of the gourmet coffee will decline by $1. Okay. So means because of good market situation, there may be a chances the prices of the gourmet coffee may get decreased. Okay. And to maximize the profit, means if the cost is same, okay, to maximize the profit, it is better to sell today. Then changes in production cost. When the production costs are expected to decline, there will be shift in the supply curve to the right, because you are able to get the higher margin. So that's why you are willing to supply more product with the current prices. A decrease in wages paid to worker would cause shift to the right in the supply curve, because a lower amount of production dollar, the firm is willing to supply more product. This is represented by the shift in supply curve from S1 to S2. So this is basically the S1 and S2. There is a change in the cost of production, and because of that reason, the entrepreneur can earn the more profit, and he is willing to supply more quantity at a particular price level. Changes in subsidies or taxes. So a decrease in taxes, because it is means any taxes or subsidies, okay, this will affect to the cost of production. So because of that reason, if the cost of production increase or decrease, okay, there is a shift in supply curve. If the cost of production get decreased, in that situation the supply curve shift to the left side, and if the cost of production get increased, the supply curve shift to the right side. So a decrease in taxes or an increase in subsidies would increase the amount of supply at each price level. Okay. So in contrast, assume that the local company produces cigarettes, and that the tax is levied on the sale of cigarettes in the state. If the company believes that the tax increase will negatively affect the demand for cigarettes, it will decrease the supply of cigarettes, which will shift the supply curve to the left. Okay, so we can take a practical example once we complete the, okay, yeah, one more. Changes in production technology. An improvement in technology would cause a shift to change the right of the supply curve. For example, a company has introduced a state-of-art technology that would significantly increase the finished bottle output for a production day. Under this scenario, the company would increase supply, resulting in shift in the supply curve. See, because of expansion, okay, or upgradation, you can produce more than earlier. If you can produce more, then you are able to sell more. Okay, and because of this reason, supply curve shift to the left side. Okay, so can you give the example of changes in price expectation of the supplying firm? Example for changes in price expectation of the supply firm, how it is impacted to the supply curve. Any example?
So the Maggi noodles prices have increased. So because of that, many consumers have gone for substitutes as well.
Okay, and because of that reason, supply may, it is demand effect. If the price
The
of price
supply also. They reduce, right? So
Yeah, because there is no demand, so that's why like entrepreneurs are not ready to manufacture. Yes, so this way you can say, okay, so there is a shift to the right side, okay, and say for a situation, okay, so where it is expected that the price of Maggie get increase. Okay, so how the entrepreneur will think if they can get the more prices from the customer after 2 months, what they will do? I'll give some clue. Holding period 2 months, and for that my inventory cost may increase by 2%. But I can get the additional price of say for 15%. Okay. So if I incur additional cost of 2%, okay, I am able to generate additional price of 15%. Okay. So what I am going to do today? All other conditions are okay. Means that is acceptable. Means even if you hold for a 2 month, even though whatever may be the production at that time and you are holding production, that also get you can dispose of or you can supply in the market. Think practically. Any guess?
the supplier will think to build up the customer base and to sell more and more products.
To sell more and more product, and I mean again like what you are going to do, you are going to
They
sell.
want to build the customer base. They
Okay.
have to achieve the customer so that they can retain for the future also, and they want to sell more and more, so they
Okay.
will retain at
No, no.
least.
But if you build a customer base in future, you can increase the production capacity in future.
Yes, sir. Irrespective of price.
Okay. But irrespective of price, absolutely. But here what happened, I'm getting a more price. I know today I'm getting a 15% price increase after 2 months. And if I'm not selling a product today and hold it for a 2 month, then the additional cost which I need to bear for a 2 month. Okay. So in that situation, what happened? I'm going to stop my supplies. Okay. For today, that supply goes down. So that is basically shift to right side. Why I am stop my supplies and I decided to stop? Because with a 2% additional cost, okay, after 2 months, okay, I am able to get the more prices. Okay. So what happened? I mean, today it is shifted to right. Okay, because you hold all your production or all your supplies, you decided to maintain as an inventory. Once you get the price increase, then you start to supply freely. So it is basically shifted to the left side. Are you able to get me? See, you always need to do, means whenever you are entering in a job, this kind of approach you need to maintain, particularly when you are in a consumer goods. Okay. Even though you have a stock, but you come to know because you declare the price increase today, no one will give the price increase on immediate basis. Okay. So market need a time to absorb it. So in that situation, you need to stock more and more and supply wherever necessary. Okay, means customer should not get shifted. That you need to keep in mind. Only that portion you need to shift it. Okay, and once you get the means you float the price increase today. After 2 months, there is a lots of contract, means lot or customer accepted the price increase. After that, you start to supply all your pending material or all your stock item. Okay, so this way you can maximize the profit.
So, but that won't be in the case of perishable goods, right?
No, no. See, again, this is the evaluation. If there is a case of perishable goods, you cannot hold it, na.
Yes, sir.
What we are doing here, my holding cost is 2%. Against that, I am getting a return of 15%. So it is better to hold the product. Okay.
Okay, sir.
Yeah. Now, can you give the example of production cost? Any practical example? Any practical example of production cost on my supply curve?
Will eco-friendly products comes under the cost, sir?
Eco-friendly product. Okay. How you are going to manage? If you go with the eco-friendly product, okay, you need to increase your prices by 10% cost. Okay. If you increase the prices of 10%, that means your profitability may go down. Okay. If the profitability go down, you are not willing to supply more. Okay, what you do here, you are floating your concept with a less quantity. That means you are willing to supply less, not more. Okay, so in initial stages, your supply is less. Once the concept is absorbed and the customer started to give the premium. Okay, in that situation, you can increase, you start to increase your supplies. Okay. So whenever the cost increases, okay, production cost increases, okay, on immediate basis, you are willing to supply get less, okay. Once you start to get the price increase from the customer, then you willing to supply more and more, okay. So this will affect the supply quantity when there is a change in production cost. Then changes in prices or the demand for other goods, we already discussed. We need to decide whether it is a complementary or a substitute, and then it will impact to my willing to supply. So first complement, and the second substitute. Okay, we are thinking about from supply point of view. Okay, so whether the demand get increase or decrease because of price or other factor, it is immaterial. Just imagine or just give a thought, if demand increase for a complement product, okay, so what is the impact on my supply of other product, other complement product?
Increases.
Yes, if demand increase, then the supply of the other complement product also increase. Demand increase of one product leads to demand increase of other product, and because of that reason, the supply of other product also get increases. What about substitute?
Increases.
Eh?
Decreases.
Decreases.
Reduce.
Yes, reduce. So it is directly proportionate and this is inversely. Okay. So when the demand for the complement product increases, it is demand for the complement product, supply of the complement product also increases. If the demand for the substitute product increases, supply of the substitute product also get decreased. Then changes in subsidies or the taxes. So it is, I mean, we need to think from the point of view of increase in production cost or decreases, because whatever may be the taxes increase, it affect to the production cost. Okay. In a same way, means directly proportion. And when there is a subsidies, we are receiving the subsidies, it inversely affect to the production cost, means our production cost get reduced. Okay. And accordingly we need to decide. Okay, so yeah, more or less you are aware, and the changes in production technology. So any practical example for changes in production technology, how it affect to the supplies?
Instead of manual, they are shifting towards machine.
Yes, because of that reason, what can be happen?
They can produce more and more products in a less time.
Produce more product, yeah. Produce more product in a less time. So what happened then? Your fixed overhead absorption rate get down. Okay, and if the fixed product absorption rate goes down, that means the production costs get decreased. Decreases. And if this situation happen, production costs get decreased, then you are willing to supply more quantity because you are able to generate more profit. Okay. So here change in quantity and change in supply. Again, this is the supply. Okay, x-axis, y-axis. Okay, at this price, the entrepreneur willing to supply this quantity. If the price increases, he is willing to supply this quantity. So it is basically this way true. Okay. So if the quantity, there is a change in demand of the quantity and change in demand of the, with respect to change in prices, then it move towards the straight line. Okay. So there is no shift of supply curve. It is moved to on the supply curve only. Now, like because of price, quantity, if because of price change, quantity demanded further decrease. So this is basically shift to which side?
Is towards the right side, so supply will increase, right?
It is right side. Okay, it is basically the main, and then this is so this is left side, right? Okay, where means okay, S1, S2, S3. Okay, as compared to S1, what is the effect on S2 if you compare S1 supply curve and S2 supply curve? Any guess? Why we need to draw three supply curve? First question.
To check the increase and decrease of the price.
To check the increase and decrease of the supply quantity with respect to price. One thing also keep in mind, in entire microeconomics, price is the base. We are evaluating quantity change and quantity price, means whatever we saw in a demand and supply, you never find change in the prices. Okay, we always evaluated change in quantity with respect to the prices. Okay, means whenever we discuss the price elasticity, that also you need to keep in mind. Whatever may be the evaluation we are doing, which is we are evaluating the demand or supply of the quantity with respect to the price. Okay, so when the supply curve shift towards right side, what does it mean? Whether it is increase in supply or decrease in supply.
Increase.
Okay, because means I'm just keeping both the slide. Okay, so if you see the arrow of the in here, if you see this, that arrow is toward left side, and that's why it is increase. We are discussing the right side, that means it is decrease in supply. Okay, even if you see the graph at a particular price, the quantity get decreased, means there is a decrease in supply when the supply curve shift towards the right side. If you see, these names are given in an opposite direction, but if you refer the arrow, then you come to know. If the curve shifted to left side, that means it is an increase in supply. If the curve shifted to right side, that means it is a decrease in supply. Okay, and the same thing exactly opposite for the demand also. Means if you see the demand, when it is shift to right side, that means increase in supply, demand. Okay, and when it is a shift to left side, that means decreasing demand. Okay, in case of the supply, it is a right side, decrease in supply. And if it is the left side, increase in supply. So that mechanism, because in examination you will get the question on it. Okay, if the demand curve shift to right side, what would be the situation? Whether it is decrease in supply or decrease in demand or increase in demand. When the demand curve shift to the right side.
Increase.
Increase in demand, correct. When the demand supply curve shift to the right side.
Increase.
Yes. Okay. So this logic you need to apply. Okay. Okay. I'll just explain in a quickly the market equilibrium because we have a 5-minute time. Okay. Okay. Whether this is the demand curve or supply curve, I'm talking about this. Means I want to know whether this is the demand curve or supply curve and whether this is a demand curve or supply curve.
Upward sloping is the supply curve. Downward sloping is the demand curve.
Yeah. Correct. Okay. So this is demand curve and this is supply curve. Okay. When these are intersect, okay, what happened? We will discuss the price floor and the price ceiling tomorrow. Okay. This is basically the equilibrium price. Okay. Means you can sell the maximum quantity. Okay. Or you can supply, means at this price level, you can maximize your demand and the supply. Okay. So that's why it is a equilibrium price. Okay. If at this point or at this point there may be a overstocking or understocking like this, that we will discuss tomorrow. Okay, so this is whenever there is an intersection of the demand curve and supply curve, that point we called as a optimum price. Okay, where the demand and supply at a highest level. Okay, any doubt? Okay. So, any point you want to understand or any topic? Any question? Any feedback? Are you able to see all the screen properly?
Yes, sir.
Okay. So, if there is no question or no any doubt, then can we close the class for today?
Yes, sir.
Okay. So, thank you all of you. Yeah. So, we will connect on next Saturday then. Okay. Bye everyone.
Yes, sir.
Thank you, sir.
Thank you.